All right, today we are diving into something that affects every single one of us, whether you're running a business or you're just trying to make sense of your grocery bill. The Fed, they are cutting interest rates, and Wall Street is throwing a party. Stocks are up, future markets are cheering, and gold's over $3,700 an ounce, which might be a clue that not everyone's convinced that this party is safe. So, today, we're going to be unpacking what the Fed's rate cuts really means and why inflation, well, it's not cooperating, and what you actually need to be watching. Chris Hobart here, the wealthologist, and here is what just happened. The Federal Reserve cut the federal fund rates. Now, the markets, they loved it, and you probably saw headlines like the Dow hits new highs and the S&P rockets past resistance and Fed's back to stimulating the economy. But here's the part that isn't in those headlines. Long-term interest rates didn't really fall. And inflation? Well, it's actually still above the Fed's own 2% target. You see, the latest data shows the PCE index, which is the Fed's preferred inflation measure, it's up 2.8% over the past year. That's higher than it was a year ago. Now, if the goal is 2% and we're at 2.8%, what are we celebrating? Uh, Cutting interest rates while inflation is rising is kind of like turning up the heat while your kitchen's already on fire. Now, some say, why in the world would the Fed do that? And a lot of folks are saying it's to keep the economy humming. Others, well, the whisper is it's about politics. Here's the reality: rate cuts make borrowing cheaper. That means more people and businesses take out loans, more money gets spent, and demand goes up. More demand equals higher prices equals more inflation. You see the problem? Now, if you're trying to cool off inflation, the last thing you want to do is throw gasoline on the flames. And that's exactly what many fear the Fed is doing right now. So, the real culprit in all of this is what we call money supply. Let's go back to Econ 101, Milton Friedman, right? One of the greats, and he said it best: inflation is always and everywhere a monetary phenomenon. Now, great, thanks, Milton. But what does that mean in plain English? Well, it means if you pump a ton of money into the economy and the amount of goods and services doesn't increase just as fast, prices have to go up. Too much money chasing too few things, prices go up. Now, as you recall during COVID, that is what the Fed did. They loosened bank rules, rates went to zero, and the money supply, specifically what's called the M2 measure, it exploded by 40% in just 2 years. You did not mishear me, 40% in 2 years. Now, by comparison, pre COVID, that money supply, that M2 money supply, it grew by about 6% per year. And as you may remember, inflation was pretty chill. So what changed? The money flood. And when you wonder why inflation hit 9.1% by 2022, there's your answer. But the question you might be asking is, isn't inflation cooling right now? And I'd say yes and no. It's down from the peak, but we're still not back to normal by any stretch. And the core issue, it's money supply. It's only recently started to stabilize. In fact, the money supply contracted in 2022 and 2023, which is rare, and now it's growing again. Now, very slowly, only 1.7% since last year's peak. And that's good news for now. But if the Fed keeps cutting and we see another money surge, inflation could really quickly boomerang right back. Plus, let's not forget about rents. Rents for new tenants dropped 8.4% last quarter. That's the steepest drop on record since 2005. Eventually, that'll reflect in the government's inflation numbers, which tend to lag real life. So, inflation is cooling, but I got to say it's fragile. So, here's the uncomfortable truth. The Fed says that it's independent, but its actions don't always match. You see, in 2008, in 2020, the Fed kept rates at zero and opened the floodgates for government spending. Now, it's trying to walk a tightrope. Politicians want cheap money. I got it. Voters don't want inflation. Got it. The Fed is kind of caught in the middle. But here's what matters to you: markets, not the Fed, are going to have the final say. If inflation starts heating up again, rate cuts, they're not going to matter because investors will demand higher returns, and that could hurt portfolios in a big way. So let me give it to you straight. Don't just follow the headlines right now. Here's what really deserves your attention. Look at M2 money supply. Is it accelerating again? If so, inflation may rise. Take a look at rented housing trends, leading indicators of what inflation might do next. Also, keep track of gold prices. When gold spikes, it usually means people don't trust paper money. Take a look at government deficits. Big spending without offsetting taxes, that's inflation fuel. If you're investing, don't bet everything on a Fed soft landing because that's a risky business. So here's what you can do right now. First, review your portfolio's inflation exposure and find out if you're overly reliant on bonds or cash. A second, consider real assets. Think about things like infrastructure, commodities, and inflation protected securities. A third, stay diversified. Chasing the latest tech hype, man, I got to tell you what, it's tempting, but it's not a plan. Also, number four, keep learning. Subscribe here, attend one of our events where we might be able to help you out a little bit, giving you some additional information. On this channel right here, I break this stuff down every week, so you just don't have to guess. So my question for all of you, do you think the Fed is helping or hurting the economy right now? Drop your take in the comments. I would love to hear from you. And hopefully you found this helpful. And if you feel even a little bit smarter about what's really going on behind the financial curtain, go ahead and smash that like button, hit the subscribe button, and also feel free to share this with someone who still thinks the Fed controls everything. All right, folks, until next time, this is Chris Hobart, the Wealthologist. Stay sharp, stay informed, and do me a favor, don't let those headlines fool you.